breaking this morning. First Republic Bank has become the second largest bank failure in U.S. history. Regulators have seized the bank, sold off most of its assets to JPMorgan Chase in a rescue deal as America's banking crisis flares up again. In a statement this morning, JPMorgan Chase's CEO Jamie Dimon says our government invited us and others to step up, and we did. He did note this will benefit JPMorgan Chase. We'll talk a lot more about it. But look, First Republic is now the third major bank to fail since March. The announcement comes just hours before markets open, and we're keeping a close eye on Wall Street to see how it reacts when the markets open. Our business and politics correspondent Vanessa Yurkevich outside of a First Republic Bank here in New York City. Vanessa, good morning to you. What is so shocking is that 11 weeks ago, Jamie Dimon and JPMorgan led the way for all these big banks to inject $30 billion into First Republic to try to save it. And even that didn't work.
That's right, Poppy. And later this morning, when this First Republic branch behind me and 83 others around the country open, it will be under new ownership. JPMorgan Chase buying First Republic Bank in a deal overnight, announced this morning by the FDIC. This was an effort by regulators to shore up consumer confidence in the banking system. As part of this deal, JPMorgan Chase will assume all deposits of First Republic Bank. So when people go to the bank this morning, their deposits are safe. This all started to unfold several weeks ago after the failure of SVB and Signature Bank. But as you mentioned, there was that big cash infusion of $30 billion led by JPMorgan. But things really started to spiral last week after the first quarter earnings call by First Republic, where they revealed that deposits fell by 40%, totaling about $100 billion. That sent stock prices falling. Just on Friday, shares were trading at about $3, down from about $122 earlier in March. We do have a statement from the Treasury Department out early this morning reacting to the news. I will read that to you. Here's what they said. Quote, Treasury is encouraged that this institution was resolved with the least cost to the Deposit Insurance Fund and in a manner that protected all depositors. The banking system remains sound and resilient, and Americans should feel confident in the safety of their deposits and the ability of the banking system to fulfill its essential function of providing credit to businesses and families. So clearly, this is an effort by the FDIC, an effort by JPMorgan Chase, and an effort by the Treasury Department to assure customers and consumers that the banking system here in the United States is in fact safe. Poppy?
It's still just stunning to see three big U.S. bank failures since March. Vanessa, thank you. We'll check back in with you throughout the morning. And Caitlin and Christine, I mean, the truth is the FDIC still is going to pay $13 billion here in terms of the cost of this.
Well, that's what they've forecast, actually, because we don't know what the ultimate cost will be, but they've said it could be about $13 billion.
And Christina Romans, you're obviously our chief business correspondent. What do we know about the details of how all of this happened and what it looks like, what they've agreed to?
It was just an amazing weekend. I got to tell you, I mean, this is JPMorgan taking over the assets and the deposits of this bank. And then there's going to be a loss sharing provision with the FDIC for anything that comes up that could be problematic on the bank's books. So a little bit of a sweetener from the FDIC to make sure that JPMorgan would come to the table. We know there was an auction of this bank. So over the weekend, you had all these banks who were vying for pieces of First Republic, but it was pretty clear.
Maybe PNC, JPMorgan, others.
By the end of last week, it became pretty clear that the FDIC was going to have to step in and take over this bank. It was not going to be able to stand alone.
Yeah, and I think if you're waking up this morning and you're looking at this, I was just texting with a top House Republican who deals with all of this, and he says essentially this is unfinished work from SVB weekend, from what happened with Signature Valley Bank.
Well,
Silicon Valley Bank.
Yeah, so let's talk about what happened there, because you had this bank, First Republic, lost 41% of its deposits. $100 billion walked out of the door after SVB and Signature Bank failed, because what happened was that showed that these banks, like First Republic, they have a lot of uninsured deposits. People didn't want to be sitting there with all of their money in a bank, more than $250,000 in a bank with uninsured deposits. And so they walked out the front door and took their money to other banks. First Republic catered to wealthy clients on the coasts. It was known for its $5 million jumbo mortgages. Yeah. So when you talk about Republicans in the House, look, nobody's crying over First Republic Bank, but you don't want chaos and turmoil to spread to the rest of the banking system as well here.
And do we think think that there's going to be more chaos in the rest of the banking system as a result of this?
So I've been talking to a lot of people over the weekend, and they think you call this unfinished business. They think that what happened with all that money that was the lifeline that went 6 weeks ago that went into
the $30 billion.
Right, that bought it some time.
Yeah.
It calmed down market fears. It bought it some time and allowed the industry to be able to find a way to manage this problem. Will there be more banks? No one knows for sure. I mean, 3 big bank failures in just a couple of months is really remarkable. But for the most part, most banks are perfectly healthy and will be able to manage this interest rate risk.
But can we talk about the FDIC report here? Because I'm obsessed with this. This is an aspect of this, talking about the root causes of here and what went down. The FDIC report basically said that because they have so many staffing shortages, that led to a part of what we've been seeing playing out with these banks.
Yeah, that Fed report on the collapse of SVB was really interesting, in part because the Fed is both the regulator and the supervisor, and basically said there were all these open red flags at Silicon Valley Bank that were not followed up on, and that management didn't understand what was going on, but also just poor bank management and oversight was not as robust as it should have been.
When I sat down with JPMorgan CEO Jamie Dimon just last month, I asked him about these string of bank failures. Would there be more? Here's what he said then.
This is not 2008. Okay, this is much more limited. There are only a handful of banks that had this particular problem. They'll eventually be resolved one way or another, and I think then people should take a deep breath. In a week or two, a lot of these banks can be reporting earnings. I think they'll probably be pretty good.
What we subsequently learned as we bring in Roger Altman, former Deputy Secretary of the Treasury and founder and senior chairman of Evercore. Roger, thank you. What we learned when those bank earnings came in is how much money fled from First Republic in the first quarter. But it's notable because Jamie Dimon, who's now leading the bank that is buying up most of their assets, is the one who led the initial attempt to rescue. He's the one who picked up the phone, called the other banker, said, let's get in here, let's try to rescue First Republic. I wonder why it didn't work.
I think it didn't work because the deposits kept leaving First Republic. What basically happened here is that after the failure of Silicon Valley Bank a few weeks ago, a lot of depositors just simply decided that they didn't want their money at medium-sized banks, and they moved that money either to the very largest banks like JPMorgan or Bank of America, or to money market funds. And First Republic in recent weeks lost almost all of its deposits. And what happens is they had to replace those deposits with a higher cost loans from the Federal Home Loan Bank Board and from the Fed, and that crushed their earnings, that crushed their share price, and it snowballed downhill.
If you're waking up this morning and you have your deposits at First Republic, if you have a mortgage through First Republic, if you pay your small business payroll through First Republic, what do you need to know? You're fine?
You're fine.
You're fine.
You're fine. In fact, all depositors in the United States today are fine.
Apparently, up to any ceiling, because...
Well, the new policy essentially, essentially is, first, all deposits up to $250,000 are and have for a long time been guaranteed by the FDIC. Second, if your bank is threatened, it becomes shaky, the federal authorities in recent weeks have made clear that they will protect all deposits regardless of size. So, effectively, if your bank is sound, your deposits are fine because the bank is sound. If your bank somehow becomes shaky, your deposits are fine because the federal authorities will protect them.
Two of the things we've learned that helped lead to this failure of First Republic, 2/3 of their deposits were uninsured. That a lot of wealthy clients, business owners, but if you talk about paying a payroll, for example, for a company of 100 people, a week payroll, 2 weeks is going to top the FDIC insured amount of $250,000. But they had a lot of uninsured deposits, and they also had a loan to capital ratio that was way bigger than most, 111%, meaning they had more loaned out than they had deposits in the bank. Can you regulate against those things? What would prevent something like this?
Well, first of all, Poppy, there's nothing wrong with having a lot of business deposits which go beyond $250,000. If you're a bank, you want that.
Right.
So there's nothing inherently unhealthy about that. What really happened here, and also happened with Silicon Valley Bank, is that in the last year or so, as interest rates rose very quickly, with the Federal Reserve trying to fight inflation and being a little late to that game, they found themselves with a mismatch. They had taken deposits, invested them in longer-term assets like federal bonds and mortgages. And as interest rates rose, they started to lose money because the cost of, in effect, of their liabilities went up and the returns from their assets didn't, and they had a mismatch. In this case, it wasn't quite as bad as Silicon Valley Bank, but it was unhealthy, and that's what really brought them down.